Picture this. You're scrolling through social media, and someone claims they turned $1,000 into $1 million by investing in just 2 stocks. Tempting, right? But before you dive in, let's talk about why beating the market isn't as easy, or as smart, as it sounds. Hi, and welcome back to Financial Futures 101. Today we're tackling a big question. Should you try to beat the market? Spoiler alert. For most people, the answer is a resounding no. Let me explain why investing in low-cost index funds is often a smart, stress-free way to grow your wealth over time. When we talk about beating the market, we're talking about managing a portfolio that outperforms the broader market, usually represented by an index like the S&P 500. This can involve picking individual stocks or timing the market to buy low and sell high. Sounds exciting, but why is it a gamble? Investing in a total market index fund means you're buying a basket of stocks that reflect the entire market. Over time, the stock market has historically returned about 7% annually, factoring in dividends and compounding. Here's the beauty of it. You're not making a bet on specific companies. You're not stressing out about day-to-day market swings. You're avoiding costly mistakes like panic selling during a recession. Over a 5-year period, your investments will, on average, grow steadily over time. Simple, predictable, and reliable. The Efficient Market Hypothesis, EMH. The EMH suggests that stock prices already reflect all publicly available information. Unless you have insider knowledge, which is illegal to trade, you're essentially gambling that you know more than millions of other investors. Even if you don't fully embrace the EMH, consider this. Most professional fund managers fail to consistently outperform the market over the long term. If they can't do it with all their resources, what do you think you can do? Multiple correct decision problems. The right stock picking is only part of the equation. You also need to know when to sell, and not just once, but repeatedly. Here's a common scenario. You invest in a company that initially performs well. Then the company's fortunes change, or it goes bankrupt. Without perfect timing, you could lose everything you've earned. Index funds, on the other hand, spread your risk across thousands of companies. If one company goes under, it's a blip on the radar. Frequent trading triggers capital gains taxes, often at high short-term rates. Also, if you invest in actively managed funds or hire someone to pick stocks, their fees can eat into your returns. Compare this to index funds, which often have expense ratios as low as 0.05%. A classic example is Warren Buffett's famous $1 million bet. He bet that over a 10-year period, the S&P 500 would outperform the hedge fund pool. The result? The S&P 500 returned 7.1% annually, while hedge funds, after fees, managed just 2.2%. Even the best hedge funds struggle to consistently beat the market, so why should you expect to? Investing in individual stocks can be fun, and I'm not saying you can't try it. Personally, I allocate a small percentage of my portfolio, about 5 to 6%, to individual stocks. I treat it like entertainment, not a serious investment strategy. The bulk of my money goes into low-cost index funds, where it quietly compounds over time. The key to wealth creation isn't picking flashy stocks or trying to beat the market. It's patience, consistency, and cutting costs. So avoid stress. Invest in the market, stick with it, and watch your wealth grow over the long term. If you enjoyed this video, hit the like button and subscribe to Financial Futures 101 for more tips on mastering your financial future. Let's build wealth the smart way, together.